Okay, thank you. It's my pleasure to introduce our kickoff keynote this morning, Carl Walter. Carl is an amazing individual, 20 years experience in Beijing, investment banker involved in some of the initial IPOs, SEO restructurings in China, chief operating officer at CICC, as well as chief operating officer of, I believe, JP Morgan. China. More recently, he has been a very successful author. He's written two very interesting books, highly recommend. Privatizing China, as well as Red Capitalism, outstanding books about the Chinese capital markets and the sort of the fragility of the underlying system. And we've invited Carl today to provide an overview, in some sense, of what's happened in China over these last 20 years, as well as to share his thoughts on the state of affairs in today's with respect to today's capital markets. And so without further ado, I'd just like to introduce Carl Walter. Thank you.
"20 years in China teaches you that you do not want to be the nail that sticks up." So I'm quite honored to be the first keynote speaker today, as well as being here at this conference, which has now been going on for some 10 years, I understand. I think the Dean's words this morning have almost taken all my own comments away from me, but I have a number of slides that I'd like to go through. I'll try and finish them up so that you can answer or ask any questions you may have. And usually I provoke a lot of response. Now, if I can learn how to use this thing. So I'm also really honored, as usual, to be in a conference or a meeting with folks who were involved with China's financial reforms from the very, very beginnings back in the 1980s. This is a small group of people who pushed forward, I think, some tremendous changes in China's financial system over the course of the 1990s and into the new century. And perhaps there are still some of them still in place today under the new administration. Perhaps going forward, there will be continued change. But these changes on the surface look like the financial markets of China and the West are converging. But if you look deeper, in fact, there's significant differences that relate to inability to privatize, despite the fact that the private sector in China is a major contributor to the country's growth, and an inability to open the currency borders to the country and allow foreign participation in those markets. So I want to talk about those things, starting off with stock markets and then moving on to capital markets. If you look at this slide, it gives you an idea of the different kinds of arenas where securities have been traded over the course of the last 30-plus years. And as I was preparing this talk, I was looking at a book called The 50th Anniversary of China Banking, 中国金融50年, and I found this wonderful quote in it, which I thought was far too honest, but it's absolutely correct. And that is that everyone believes that stock markets are a cheap source of cash. So one of the things I want to talk about is how over the last 20 years, not the 1980s so much, but as the 90s and in the new century, you really have an inability to come to grips with what corporate finance means. If we go back to the 1980s, according to the godfather of the China stock markets, Liu Hongru, there were around 9,000 entities that had issued something called shares in an effort to raise funding during that decade. These shares appeared to be more like bonds or debt securities in that they paid an interest rate, but they were called shares. If you look just on the eve of Deng Xiaoping's southern journey to Shenzhen, this is what this very, very limited market looked like. And what it shows is that in Shenzhen, some 64% of the shares that had been sold or capital that had been raised was from non-state providers. there was in essence privatization going on in Shenzhen, whereas the rest of the country, that was not the case. But this is a very, very limited sample. On the other hand, it does show that local governments will sell anything they can to raise funds. From 90 to 93 is when the original sin, when the markets really began to form. I call it the original sin, and you'll understand in a second, the yuanzhe. But in 1990, the State Council approved the establishment of the securities exchanges in Shanghai and Shenzhen. They were more for this, to bring a very unruly curbside stock markets inside walls, and also to begin to trade Chinese government securities. When Deng came down to Shenzhen, it still amazes me that there is so little made of Mr. Deng in China, at least publicly. But what he did was he gave political cover to these nascent markets. And I can still remember in 1992, how being in China, how I felt like the whole country was for sale and was going to change overnight. That same year, Zhu Rongji, who was the vice premier in charge of finance at the time, gave approval to the Hong Kong Stock Exchange proposal to list state-owned enterprises here in Hong Kong. And then later that year, in October, the CSRC was established. And finally, in 1993, China's first corporate law, the Standard Opinion, was enacted. So what were the consequences of all this? Well, I think the most important one and the greatest contribution that all this effort has made is that for the first time in its history, China has a national market for capital. This market ultimately led to the creation of the first large-scale national companies in Chinese history. But on the other hand, if you look at the costs that were associated with getting these reforms put in place, you found that, first of all, the shareholding experiment, and it was an experiment until 1998, was limited to SOEs only. There was a condition that there would be no privatization, so the only minority shares would be sold. And it created share classes based on the holder's relationship to the state. Finally, by opening up Hong Kong, the Hong Kong Stock Exchange as a venue for the best Chinese companies to list, it subordinated the development of the domestic exchanges to Hong Kong's international exchange. And finally, I'd like to pass over this right now, but I said that it really did fail to achieve, I believe, Zhu's goal of SOE reform. But I'll come back to that in my final comments. How do I point this thing? I guess I'm just two. Where is it? Thank you. So let me talk a little bit about the share classes to begin with, because this is the dominant feature of China's stock markets up until 2003, 4, and 5. There were many markets, there were many regulators, it was all the stock of the same company. So if you look at one company's stock, there could be state shares, which the state owned directly, there could be legal person shares, which a SOE promoter owned, there could be the A-share markets, which retail investors participated in, there could be the offshore markets. There was some layover or some intersection of these four markets, but not very much. And each of these markets had different regulators. It had different laws, different kinds of disclosure. It was completely different. So how do you value a company like China Eastern Airlines? China Eastern was listed, it's a dual listing in New York and Hong Kong. It also listed in Shanghai later on. So here's four ways to try and arrive at a listing of China Eastern. I'm not going to go through each of these, but just to give you an idea down below, in the $2.2 billion valuation of the company, it's the A shares plus state shares times the A share price. So these prices are very, very, very different. If you start taking into consideration state shares, this was at a net asset value price, a pure accounting sort of convention. That's why you have much smaller values over on that side. And this was really the problem with the early markets. I mean, what is a stock market meant to do? It is meant to provide a price for a company that is listed on it. 2005, there began to be, they tried to address this issue, tried to take these share types and meld them all into A shares. And what this did was, number one, it got rid of the original sin in that retail investors were compensated for the original belief that the state would never list their state shares, and that therefore only the A shares would be trading in the Shanghai exchange. And finally, it made the CSRC, the China Securities Regulatory Commission, the only regulator of the domestic markets. However, you still have an RMB Great Wall. So this beautiful, beautiful chart, which my co-author Fraser Howey made for me, and as usual has tons of information on it, tries to do what the Hong Kong Exchange's premium discount index doesn't do. It disaggregates the companies whose shares trade at a discount or a premium, Hong Kong to Shanghai. So if you look at the number of companies as the jagged line, it increases over this time period. The discounts down on the bottom, the premiums on the top, the brown line there is the average discount. So the idea there is that although perhaps you have one share class, one type of shares now trading in China, in fact, for those companies that are listed overseas as well, you still have a very difficult time coming to some kind of valuation of what it is. If we look at primary market pricing, here's the famous IPO chart graph. We tried to look at the first day pop, the first day average turnover. The blue line is the number of listings in a given year. And you can see that the average first day pop has sometimes been very, very significant. If shares were priced like this in New York, I don't think many senior executives or investment banks would remain involved with these kinds of listings. Two of my favorites are PetroChina and China Shenhua. This chart tries to show you how funds are redirected among strategic investors. What it shows here is the difference between the listing price and the price of the share after one day. So you can, in the case of PetroChina, there's a 45 billion renminbi valuation difference. That means that it left 45 billion renminbi, almost $8 billion bucks, on the table, and the company didn't get that money. Somebody else got that money. And we would talk about strategic investors. Other SOEs who made strategic investments probably did enjoy that. Similarly with China Shenhua, I'll never forget the words of the chairman, Chen Biting, who said, "I was a wee bit disappointed with the performance of my IPO." Well, he left 15 billion renminbi on the table. But somebody appreciated that. Problem is the lottery system in China is rigged to favor large investors. You can look at the details here. This is a system that requires you to fund your application, and your success rate is based on the number of applications you have. As a consequence, it favors the guys that have a lot of money or can borrow a lot of money. If we look at the participants in the market, the actual number of accounts trading is very, very small. If you look at the open accounts in Shanghai and Shenzhen, which is the number you guys always talk about, it's over 100 million accounts. But if you actually look at the accounts holding securities, maybe it's around 30 million. And if you look at the accounts that actively trade in Shanghai and Shenzhen, it's less than 10 million. So what are these accounts? You luckily can, from China Clear, you can get the information on the actual accounts. Institutional investor accounts on top, they account for 17% of the total value, or our total estimation of the value in the stock accounts. Retail guys are on the bottom. But if you look at the money that can be deployed by the institutional investors and by these 20,000 or so so-called retail investors who have between 10 to 100 million renminbi in their accounts, you can well imagine that the bulk of the retail investors at the 50,000 assumed value per account are really not getting involved with these IPOs very much. So who is benefiting from this tremendous mispricing of IPO shares? A brief word about corporatization. Maybe in 1997, I was standing in my office in Beijing, and I was waiting for the Minister of Finance from the Ukraine, as it turns out, to show up. And he was a very young man and very puzzled by the ability of China to get its state-owned enterprises, which in Ukraine made no money at all. How could they possibly list? And on not only in Shanghai, where maybe things are a little bit easier to manage, but also in New York and in Hong Kong and in London and so on. How did these things happen? What we learned in the beginning was that you had to restructure these non-specific piles of assets into companies that were limited by shares. And to do that, you took the kernel of a SOE, and hopefully that kernel would be profitable. But you left everything else behind in an unincorporated state enterprise group. You had a state agency, maybe an industrial ministry. You had later on the share investors, and you had a board of directors. So you had a kernel of something that was a company that looked like the same kind of company internationally, but it had left behind everything else. This is why, so I'll change that. And then this company went on to list shares. It became, there was an audit by international audit firms. There was work done by international lawyers, and international bankers would design and list these things and raise money for the state, or for the company and the state. So this was how the first 5 or 6 years went. There were 5 or 6 batches, if I remember. There were about 80 companies selected. These were all single SOEs. Of these, maybe 40% got listed. The other 60%, no matter how you sliced and chopped it, could not get listed. So by 1996, as China was emerging from inflation, there really were almost no companies left untouched in China by investment bankers wanting to make a buck. And I can remember on the last list, Beidahuang, which was a big farm up in Heilongjiang, was meant to be a listed company, but could not be done. The question is, what do you do? Well, 1997, we all know what happened here in Hong Kong, but also was the year of the Red Ship. The Red Ship was a conglomerate type of a listing in which, in Beijing Enterprise case, had an ice cream factory, the part of the Great Wall, things like this, all thrown together in a way that could be profitable and then listed in Hong Kong. So this concept, I think, led to the creation of China's first national companies, in which you had parent groups of SOEs and local governments brought together in a holding company to list a company, a larger nationwide type company limited by shares. And the first one of its kind was really China Telecom in late 1997, just before the Asian financial crisis broke out. This raised $4.4 billion in one whack. The largest deal that had been done before that was $600 million for my famous railway company. Anyway, what I'm trying to show here is that these six provincial telecoms bureaus were consolidated under a brand new company, China Mobile Communications, and so on down to China Mobile BVI, and then listed simultaneously in Hong Kong and New York. So what's the implications of this thing? Well, aside from what I've commented on there, this really, you're creating a company, a national type company, and making it appear to be a unified, integrated company, and then pricing it as if it were based on comcos of other national telecom companies around the world, when clearly this is almost like a startup. My big question about China Telecom or Chalco or PetroChina or Sinopec is whether they are really integrated companies, managed as if they were one single company, or whether they continue to be bits and pieces of provincial enterprises state-owned enterprises or other kinds of government bureaus. That's my first question. The second question is, you can really see from this what you're doing is you're corporatizing and listing the Ministry of Posts and Telecommunications. So you've changed the surface of this ministry into that of a corporate entity. But in fact, and you've given it a tremendous cash flow. The next year, these guys raised $36 billion by the addition of 7 more provincial telecom bureaus, raising tremendous amounts of money, having tremendous amounts of cash flow, and creating a tremendously powerful political lobby domestically. So that concludes my comments on stock markets. Let me just say a few words about the debt capital markets. You can see that China, since 1992, has developed a huge primary debt capital market. You have Chinese government bonds, CGBs, local government bonds, policy bank bonds, bank subordinated debt, and corporate bonds. And you've really seen a tremendous pickup in issuance volume over the last 7 to 8 years. The first driver of these was really a central government debt dependence. This thing looks like a fish on my plate, but what it tries to show you is that after transfers to provinces are taken into account, the central government is really left with a revenue deficit, and it is filled with bond issuance. So this is one thing that has driven the markets. Second thing was really in the last 6-7 years was the central bank's effort to develop different products in the debt capital markets beyond Chinese government bonds. So you had the creation of commercial paper, medium-term notes, some ABS activity, and laterly trust products. But the effort was try to create a real renminbi yield curve to support interest rate reform. There was an effort to create RMB risk management derivative products at the time. And there was an effort to try and diversify corporate borrowing away from bank lending. And there was a failed effort as well to get market regulation under the PBOC. NAFME there is the National Association of Financial Market Institutional Intermediaries, I think. The problem is this, though. The market doesn't trade. This is 1 day's trading of Chinese government bonds. 160 trades. In New York, every day there's 500,000 trades, $1 trillion. So where is the yield curve? The CDB is the China Development Bank, which is a semi-sovereign proxy, I think, for the Ministry of Finance. Where is the yield curve in this? Well, here is a picture of China's yield curve, but it is a yield curve that is filled in by folks because there's no trading at those data points, at those tenor points. So right now, the solid data points indicate there's no trades at that tenor, and yet we have a nice yield curve. We have mandated pricing. Here's the bond. Here's your credit ratings and the mandated pricing over the Ministry of Finance. The Ministry of Finance is quadruple A. And the last time I went through 3,000 trades on a couple of years ago on the bond market, there was one BBB plus private entity. If you look at the corporate debt product, there's more trading, especially in the short term, 1,500 trades a day. There are 9,000 market participants. How can there be such little trading? Well, if you look here, I've got AAA and AA plus, and I've written liquidity premium. People do trade, but the prices vary wildly for the same credit risk. What is really going on here? My understanding is that at some points in time, people have to sell a bond into the market, and when they do, they take a haircut. They take a haircut because bonds, when they're originally priced in the primary market, are priced too low. They are priced basically off of the 1-year lending rates, which relate to the 1-year deposit rates at the banks. So when you sell a bond into the market, you are losing money. Here's another way of looking at market turnover or liquidity. You can see that even last year, in 2013, government bonds did not turn over at all, 0.2 times. The PBOC notes turned over once. But the bank bonds bank financial bonds did not turn over hardly at all, and so on. So there's very, very limited liquidity here because the bonds are mispriced in the primary market. So I want to talk a bit about investors, and I'm going to be done. This is a disaggregation of China's national budget. And the red line shows the amount of the national budget by percent that is invested in economic and fixed asset investment. As this went down to almost below 30% in 2006, it was removed entirely from being part of the budget. I'm talking about fixed asset investment in 2007. And this investment, however, continued, as you all know, but it was put on the backs of banks. So if you look at state banks not only are lending into the local government fixed asset investment projects, they are also almost the primary sources of investment for China's bond issues. They are not intermediaries. I think they are channels. They take funds from the depositors and channel them into the debt markets or into the loan markets based upon administrative directions. And increasingly, they're taking money from offshore banks, including those in Hong Kong, and doing the same thing. China is growing increasingly obligated internationally. State bank balance sheets are obstacles to reform because they still remain, despite the superficial appearance of a debt capital market, the only source of capital in town. So I want to just sum up and then see if you have any questions. There's no question that all of this has created for China true national capital markets. They've created a national team of national companies that had never existed in China's history before. But the question, and they have, these all rest on Western accounting and legal edifices that we've all been involved in erecting. But it still remains very unclear exactly what we have built. And if the question really is, if we've built these national champions and built these markets, what are the markets really trading? And although these champions may be national champions, where is the international champions that China really needs if it is going to compete in the 21st century? Those are my comments, I guess. I really appreciate being here. Thank you so much to the conference for having me. If you have questions, I'll try and answer. Thank you. I think I did just about right.
Maybe I want to ask that we heard about that there will be a direct link in terms of the Shanghai stock exchanges and the Hong Kong stock exchanges. What do you think that will be implication to the China's capital market? Yeah.
Fruit train was first announced in 2007. It has not left the station yet. I think there's been a lot of noise since the 17th Party Congress about financial reform. And every once in a while, one of these ideas pops up. But we're still waiting for the execution of that idea. You would have thought that if this idea had first come up in 2007, that perhaps the paperwork and laws and regulations were already in place for this to be enacted almost immediately. And yet we're told that it will take 6 months. So I'm waiting to see what happens. If it's true that capital can go into China without undue bureaucratic interference, it's fantastic. But I guess my comment in the beginning about Zhu Rongji's effort to reform the SOEs, it failed because the point was that the Hong Kong Exchange and international investors would provide the kind of scrutiny and the kind of regulatory framework that China at the time could not provide. And yet, here we are 20 years later. It seems like the big national champions that have been created are bigger than the regulators almost anywhere, including in Hong Kong. So I don't know what's going to happen, but I'm from Missouri in the United States. Show me. You're first. Then I'll come back to you.
I was very interested in your description of the way they were putting these state-owned businesses together in a profitable entity, although I have to say, we invented this system in the United States a long time ago. We just called it Enron. But the problem, but the problem, of course, with Enron, and then the problem, the nut of my question to you is, obviously off the books, there are tremendous liabilities being accumulated in the same entities, which everybody's basking in the glowing profits of. At some point, is there going to be a come to Jesus when all these sums have to be come together and balanced out?
Well, there was a famous comment made maybe a decade ago by a regulator saying that the controlling investors in these listed companies treated their listed subsidiaries as ATMs. And I doubt that that has changed much today. I think this accounting conference is absolutely right to be looking at this topic, because I really wonder sometimes how a firm can sign off on Chinese bank balance sheets. For what? I guess the answer to your question is when you slice up an SOE and create a listable entity, you're leaving behind, at the time when you begin doing this, nobody knows whether you can do it. There's never been an audit. The company itself doesn't even know whether it owns the assets. The company itself has 2 or 3 different accounting departments. So you have to put all of this together. So what gets left behind is a part of history. What comes forward is still, the umbilical cord has not been cut. The question you're really asking is, what are Chinese public obligations? Because these are all publicly known enterprises. And I don't think anybody knows the answer to that. So, sorry, go ahead.
Yeah. So you have been spending a lot of time in China, and you also list a lot of issues facing China. So now let me set a boundary. First is, let's assume the state will not give up control of the SOE monopolies in different sectors, including like China Telecom, China Mobile, right? So given this constraint, in your view, what should be done in China to improve the efficiency of those firms?
I think, sorry, I can't hear too well. If the state does not believe in privatizing, what should the state do to make it more efficient? Well, I think that the state sector in China has been trimmed back significantly over the last 30 years. And that what really drives the economy is, if the real economy is the non-state sector, whether it's multinationals or the huge supply chains or Chinese entrepreneurs, we don't see that. We focus too much on these big corporations or banks as if they were China, but I do not think that they are China. The problem is, all right, how do you lend money to these guys? And I can tell you it's very hard as a foreign bank that supposedly knows how to value risk and reward. It's very difficult to lend to the small and medium enterprise sector in China, because there really is not any auditing or legal systems that you can fall back on if things go wrong. So what should China do? Instead of inviting Alibaba and Tencent and a number of smaller SOEs to open up so-called private banks in very limited geographic areas, China, I believe, should force its banks to become more competitive by opening up, by enabling foreign banks in China that have been there for 20 plus years to have enough capital so they could be truly competitive. That's the problem. We can't get enough capital. If you can't get enough capital, then you can't lend. Hope that helps a little bit. Jesse.
Hi, Carl. Can I just make some comments? Yeah, I think that we all enjoy very much about your presentation and your excellent book, because as you know, you all know that Carl stayed in China for over 20 years with lots of practice experiences, plus later on lots of research work. I still remember that Carl at that time, at the beginning of 1990s, worked for First Boston and did the first U.S. listing At that time, I was just sitting in the CSRC as a young regulatory body and subject to their due diligence. And the team wants to see that the Chinese regulator or government whether support this kind of efforts. And also, Carl, in the 1994, the team did the first N-share listing, which is Shandong Huaneng. And I remember that the August 5th, probably, at that time it was about the 6 o'clock in the afternoon. I got a call from him from New York, and the 6 o'clock in the morning in New York. He said that he wanted me to try to find the Liu Hongru, the chair, about the pricing. They fight for whole nights, very emotional, all dirty words and quarrels, whatever, couldn't come into any compromise or something. Therefore, as I said, that since he has all kind of rich experiences, and then later on the practice, the research, so he can make an excellent presentation and a lot of valuable views. But I would also say something maybe from different angle. I would like to respond some of the issues Carl raised at the early part of the presentation, that is the capital market, because I couldn't speak too long, right? There's a chart shows in Chinese capital market there are many different kind of shares. There's circles which some overlap, but many of those are not. Why it is? It's whether it's like that. Why whether the Chinese are just quite stupid or had whatever purpose? I would explain that because our today is associated with yesterday. It's not born today from nowhere. So what was before the capital market started? It was centralized socialist planned economy. Therefore, actually, when we started this sort of a market experiment, still lots of concerns about so-called privatization. Therefore, at that time, as Liu Hongru later said, when we tried to make a reform of we called untradeable shares tradable, at that time he said, if I let the state shares trade at the day one, we couldn't have the capital market even today. Therefore, it was, on one hand, you will see it's a kind of a strange animal, but on the other hand, you may say, oh, it started. So at that time, basically, they issued new shares, which is A shares, for instance, allowed the public to participate, and so it remained till, say, like 2005. Then we had a sort of reform of the untradeable shares. The other question is that Carl said that at the very beginning, it was basically just state-owned companies allowed to issue shares. In reality, CSRC has no such intention to only allow state-owned. We didn't really concern that if it's a private-owned, it cannot allow. However, at that beginning, we introduced a quota system, which linked to the previous all the funding also under the state plan. Therefore, at that time, the NDRC, together with Reform Commission, jointly set up 5.5 billion quota to start the experiment at the very beginning. Therefore, actually, the quota then distributed to each province. And at that time, the state-owned companies were facing the market challenge. They had no idea how to handle market. So they were most of them fall into difficulties. And they deemed, the local government deemed the state-owned enterprises were their son. So of course, they would distribute the quotas to the state-owned, not because the national policy prohibit the private. They just most of the cases, they couldn't get shares, get a quota. However, there is some exceptional. For instance, there is a company called Oriental in Heilongjiang province. It was private owned. And when they applied to issue 800 million shares, something like that. And CSRC, as I was one of the first IPO committee members, we had a constant discussion. We say, oh, this guy, if he raised money, could he disappear? Then how we handle the public investors angry, something like that. Whether we should approve or not. We approved. He didn't disappear, so we all feel, oh, okay, relieved. So that anyway, that was something. And the other issue is that why the tradable share is so small. When we give the quota to each province, the government try to benefit as many as state-owned SOE. Therefore, they just try to slice to the minimum, which is 25% of a company after it's issuing. Therefore, many of those, just about 10 million shares, something like that. That's possibly the minimum. So those are, I agree with Carl, that left a lot of problem for the capital market. However, as I said, that if you look at the history, and if you look at the progress, you may think that is the other, if you look at it from other angle, that might be the wisdom. The Chinese try to overcome sort of the planned economy and transfer to market economy, which is very bumpy till now. But if it, as I said, that if you look worldwide, all the old socialist system or communist system, whatever, which country except China built capital market? Like Russia, like Vietnam, like wherever? No, only China. Just like if you look at the capitalism or market economy, where is the largest market? It is in the US, then in UK. People say Anglo-Saxon because of the legal system. So there are some reasons when the markets developed. So why? Well, I mean, the Chinese capital markets still have a lot of problems, but I think it will continue to evolve. So I really appreciate Carl's presentation. Thank you.
Well, there's no question that you're absolutely correct, Jesse. Just and I'm totally aware of that history. I guess the real issue is, and I should lend that Deng Xiaoping wasn't wrong, but he's not right yet either. So, but I think the problem is how do you transition out of a old history-laden type of a system, whether it's Soviet or whatever you want to call it, and into a more market-based one. I think for Chinese government officials, it remains exceptionally challenging to believe that something that you cannot even see, called the market, can be the one that channels all the capital to the economy. I really think it's difficult, and what has been achieved in the infrastructure is quite something.